Welcome to the Deep Dive, your shortcut to being well informed. Today, we're tackling a really fascinating and pretty controversial player in the whole green transition story, TMC, the Metals Company, Inc. And look, this is a wild one. You've got a company aiming for this multi-trillion-dollar resource, right? Metals we absolutely need for EVs, for battery, critical minerals. Exactly. But here's the kicker. They make zero revenue. Nothing. Zip. Yet they have a market cap around $3.6 billion, supposedly sitting on a treasure chest worth, what, $23.6 billion at the bottom of the Pacific?
That's the projected number based on their resource estimates, yes.
So the big question, the one we really need to unpack for you today, is this. Is this some kind of generational chance to secure our mineral future? Or is that $3.6 billion valuation just...
Well, hype, pure speculation.
And because, after digging into all the analysis, the conclusion seems... pretty stark. The stock closed at $8.89 on October 10th, 2025. And that price, it's right at the absolute peak, the very top end of even the most optimistic valuation models out there.
Which leaves basically no room for error. None at all.
So our mission today is to cut through that noise. We're going to look hard at TMC's structure, its financials or lack thereof, and the, frankly, extreme risks involved. Risks that could either make that $23.6 billion real or just sink the entire venture.
We want to help you figure out if TMC has really found a sustainable path to these essential minerals or if it's something else entirely.
Okay, but before we dive in, a quick word about Stock Analytics AI. Please do like and subscribe. For just €4.99 a month, you get access to our huge library, over 500 deep dive videos covering the entire S&P 500.
And we're rolling out NASDAQ 100 coverage next exclusively for members.
Plus, members can request deep dives on specific stocks. Just drop the ticker in the comments and we'll get on it for you. All right, let's get foundational. Let's really unpack what this company does. Chapter 1, business analysis. The $23.6 billion rock. Okay, so TMC, at its heart, is what you'd call a pre-revenue mineral exploration company. Development stage, really.
Their whole plan, their entire model, revolves around collecting these things called polymetallic nodules.
Right, nodules. If you haven't seen pictures, they literally look like, well, potatoes. Potato-sized rocks just sitting on the seabed, 4 kilometers down, maybe more.
Deep. In a specific area called the Clarion-Clipperton Zone, the CCZ, which is this vast abyssal plain between Mexico and Hawaii.
But these aren't just any rocks. They contain 4 critical metals all in one package. Nickel, copper, cobalt, and manganese. All essential for batteries.
And that's the core of their value proposition. It's quite novel, actually. TMC argues that getting these metals from nodules is fundamentally more sustainable than traditional land mining.
How so? What's the argument?
Well, the claim is you avoid cutting down rainforests, you avoid displacing habitats on land, and crucially, you eliminate the massive amounts of solid waste tailings that land mines produce. Those can be toxic.
And I heard the ore grade is much higher, too, meaning less rock processed for the same amount of metal.
That's the claim, yes. Higher concentration of the target metals in each nodule compared to typical land ores, which in theory means a smaller processing footprint.
Okay, and the scale here is just mind-boggling.
It really is. They hold exclusive exploration rights sponsored by the Pacific Island nations of Nauru and Tonga. Just one area, the NRID block, covers over 25,000 square kilometers.
That's huge, like the size of Sicily underwater.
Exactly. And it's this area, with its declared mineral reserves, that forms the basis for that projected $23.6 billion net present value, if they can actually pull it off and start commercial extraction.
Okay, massive resource. Potentially cleaner extraction.
Yeah.
But let's push back on that sustainability claim for a second. You hear the term greenwashing thrown around a lot with PMC.
Oh, absolutely.
I mean, we're talking about disturbing a deep-sea ecosystem we barely understand. Is it really better than, say, mining on land where we at least have some experience with remediation, even if it's imperfect?
And that is the absolute core conflict for them. It's the accusation opponents constantly make. TMC's biggest challenge, beyond the technical stuff, is convincing environmental groups, scientists, and maybe most importantly, the end users, think car companies, that scraping the seabed is somehow environmentally preferable to digging holes on land.
Because if the big EV makers say no thanks to deep-sea metals,
then the whole business model collapses. It doesn't matter how good the PEC is or what the NPV says, it becomes a massive reputational market access risk.
Makes sense. Okay, now let's talk about maybe the biggest hurdle right now. Not the environment, surprisingly, but regulation. Let's call this the regulatory bottleneck, the high-stakes pivot.
Yeah, this is critical. The whole deep-sea mining industry is basically stuck in limbo. Why? Because the International Seabed Authority, or ISA, that's the UN body governing activities in international waters, they still haven't finalized the actual rule book, the mining code for commercial
They've
exploitation.
been working on it for years, right?
Oh, years and years, lots of debate, lots of delays, and this stall forced TMC into making a really aggressive, some would say risky move, a pivot.
What did they do?
Well, instead of just waiting indefinitely for the ISA, TMC decided to go a different route. They're trying to get a commercial recovery permit under an old, largely forgotten U.S. law, the Deep Sea Hard Mineral Resources Act of 1980, DSHMRA.
A 1980s U.S. law. Why now?
Because, and this is key, that old law got new life breathed into it by a U.S. executive order in 2025, an order specifically prioritizing deep-sea mining as a matter of, well, national mineral security, the geopolitics, essentially.
So what does this dual-track strategy really mean? Going for a U.S. permit while the ISA is still figuring things out.
The implications are huge. Look, by seeking a permit under U.S. law, potentially backed by this national security push, TMC might be trying to sidestep the slower, possibly stricter international process governed by the ISA.
Giving them a head start.
Potentially a multi-year head start over any competitors waiting on the ISA, yeah. It reframes them as a strategic U.S. asset. But it's incredibly controversial. Many ISA member countries, environmental lawyers, NGOs, they argue this undermines decades of international law development, the whole law of the sea framework.
So legal challenges seem likely then.
Almost certain, I'd say. It's a high-stakes gamble. Success could mean market dominance. Failure could mean getting tied up in court for years.
Okay, so we've got the business model, the resource, the regulatory drama. Let's zoom in on the people steering this ship, especially when you're pre-revenue. Leadership is everything. Let's move to Chapter 2, Management Evaluation. The Shadow of Nautilus. The CEO is Gerard Barron. Seems like a seasoned entrepreneur, definitely has experience raising capital.
He does, but there's a significant shadow hanging over him, something investors absolutely cannot ignore. He was involved as an early investor in another pioneering deep-sea mining company called Nautilus Minerals.
Nautilus. Wasn't that the company that collapsed? Burned through a ton of cash.
That's the one. It went into administration in 2019 after failing to get its project off the ground, despite raising hundreds of millions. Barron's involvement there, even as an investor, inevitably raises questions.
Questions about what? His judgment.
Huh?
Or just the sheer difficulty of this industry.
Probably both. It highlights the inherent, almost existential risks baked into deep-sea mining. Nautilus's failure wasn't necessarily due to bad management alone. The technical and regulatory hurdles proved insurmountable then. It forces you to ask, what's fundamentally different this time?
Right. So Barron was involved in a similar venture that failed spectacularly. How does the current team, build credibility against that backdrop? Isn't that like a major red flag for the whole sector?
It's a huge red flag they have to actively manage. And their answer, their strategy to counter that history seems to be this capital-light, de-risked approach they talk about. They're not trying to do everything in-house like Nautilus maybe tried to.
They're using partnerships, right?
Exactly. Really strategic ones. They brought in Allseas Group, a massive, highly respected offshore contractor. Allseas provides the specialized vessel, the hidden gem, and the collection technology expertise. That takes a huge technical burden off TMC's shoulders.
And the other big one was Korea Zinc.
Crucial. Korea Zinc is a global smelting giant. They made a significant strategic investment, about $85.2 million. But more importantly, they provide a guaranteed pathway for processing the collected nodules. That solves another massive problem.
Yeah, because building your own multi-billion-dollar processing plant from scratch,
Yeah.
that's a whole other mountain to climb.
Precisely. So this capital light model, using these powerful partners, combined with that aggressive regulatory pivot towards the U.S., that's management's strategic response. It's what's keeping investor confidence relatively high, despite the Nautilus history and, frankly, ongoing reputational issues.
Like the short seller reports. I saw mentions of conflict of interest concerns around a loan involving the CEO.
Yeah, those accusations are out there too. It adds to the complexity. They're battling on multiple fronts: regulatory, technical, financial, and reputational. But the partnerships, especially Korea Zinc, have helped stabilize the technical and processing aspects, at least on paper.
Okay, so even with the Nautilus ghost and the greenwashing claims, the partnerships seem to be keeping the dream alive. Which brings us, inevitably, to the money. Let's tackle Chapter 3, Financial Analysis. The valuation canyon. Let's just state the obvious first. The harsh reality. TMC has generated zero revenue for 5 years straight, and their trailing 12-month net loss is running at about, what, $131.5 million?
That's right. So standard things like PE ratios, price to sales, they're completely meaningless here. There are no earnings, no sales.
But here's the surprising part. Despite burning through cash like that, their balance sheet looks relatively stable.
It's quite interesting, yeah. Management has been financing primarily through equity raises, not loading up on debt, so their debt-to-equity ratio is actually quite low, around 0.20.
Okay, so they're diluting shareholders, but not risking bankruptcy through debt.
Essentially, yes. And their liquidity looks decent, too. A current ratio of 2.37 suggests they have enough liquid assets on hand to cover their short-term bills. They've managed the cash burn carefully enough to, well, keep the lights on while they pursue this high-risk path. It looks more like a well-funded, late-stage startup than a company about to implode financially. But those losses are real, and the clock is ticking.
All right, now the absolute core issue, valuation. For a company like this, with no revenue, you really only have one tool, right? A discounted cash flow, or DCF, model.
That's the standard approach, yes. You project future cash flows if they ever materialize and discount them back to today's value based on risk. But therein lies the problem.
It's hypersensitive to the assumptions you make, especially about risk.
Exactly. And with TMC, we've seen published DCF analyses that are just miles apart. It creates this massive valuation canyon.
How far apart are we talking?
Well, you've got one optimistic model, the one presumably driving the bull case, that spits out an intrinsic value as $8.86 per share. But then you have highly skeptical models that arrive at a value closer to $0.58 per share. 58 cents.
Wait, hang on. $8.86 versus 58 cents. That's not just a difference of opinion. It's a completely different reality. How can the models be that divergent?
It boils down almost entirely to one critical input. The discount rate. That's the rate you use to reflect the riskiness of those future cash flows.
Okay.
The optimistic $8.86 valuation, it uses an incredibly low discount rate, around 6.9%. Now, a rate like that might be appropriate for, say, a stable dividend-paying utility company with predictable earnings.
But not for a pre-revenue mining venture facing massive regulatory hurdles and unproven tech at scale.
Absolutely not. It's exceptionally aggressive. A conservative investor looking realistically at all the risks we've discussed, the ISA uncertainty, the environmental backlash, the technical scaling challenges, the Nautilus history, they'd demand a much higher rate of return for taking on that risk. They'd use a discount rate maybe in the 15%, 20%, even 25% range.
And plugging that kind of rate into the DCF model
Instantly crushes the present value. It pushes the calculated intrinsic value way down towards that bearish $0.58 estimate. So what this tells you is the market right now isn't really valuing TMC on fundamentals. It's valuing it almost purely on risk appetite and belief in the narrative.
That makes so much sense now regarding the stock's volatility.
Huh.
Okay, we've covered the core business management and the shaky financials. Let's shift gears now. Let's look at what the market is thinking and doing. Chapter 4, market sentiment, trading on narrative. I mean, just look at the stock chart. It shot up from under $1 at the start of 2025 to nearly $9 recently. That's not fundamentals driving that. That's pure narrative.
Absolutely. The market has latched onto a few key catalysts, powerful story points.
Number one has to be the geopolitical angle, right?
Yeah.
That April 2025 U.S. executive order basically saying deep sea minerals are vital for national security.
That was huge. It reframed the entire investment case for many.
Yeah.
Suddenly, it wasn't just a mining company, it was potentially a strategic national asset in the competition with China.
And second,
Tangible regulatory progress, or at least the appearance of it. TMC actually filing that U.S. permit application under DSHMRA, that was a concrete step, something the market could react to.
and third, that Korea zinc deal we mentioned.
Yes, the strategic validation. Getting $85 million in a processing commitment from a major industry player like Korea Zinc provided significant third-party endorsement. It made the whole thing seem more real, more achievable.
But here's something interesting. The analysts seem a bit behind the curve. I saw the consensus rating from 5 analysts is technically a strong buy.
Which sounds great.
But their average price target is $8.75, which is actually below the recent closing price of $8.89.
Right. The stock has literally outrun the analysts' own models, even the bullish ones. It suggests the current price is fueled by momentum and perhaps retail speculation more than institutional conviction based on near-term targets.
And what about the doubters? Is there significant short interest?
Oh yeah, it's notable. Around 11.71% of the available shares, the float, are sold short. That's quite high.
Meaning a lot of bets against the company succeeding.
Exactly. It signifies a deep polarization in the market. And with about 3.2 days needed for shorts to cover their positions if the price squeezed up, it also sets the stage for potential high volatility. Big swings are likely.
Okay, so a polarized market. Let's look closer at who's actually holding the shares, who's making these big bets. Chapter 5, ownership structure. A late-stage VC bet.
The ownership structure is really revealing. It doesn't look like your typical publicly traded company at all. It looks much more like a late-stage venture capital investment.
How so? High insider ownership.
Extremely high. Insiders collectively own around 64.90% of the company. That's massive alignment. CEO Gerard Barron himself holds about 4.4%.
And are they buying or selling?
Overall, the net activity over the past year has been positive, about 15.6 million shares bought versus 3.1 million sold by insiders. There have been some recent sales, potentially for diversification, but the trend is more buying than selling.
Why would insiders plow so much of their own net worth into a zero-revenue company with so many risks? Is it just belief in that $23.6 billion number?
It's belief in the binary outcome, I think. They're betting big that they can overcome the hurdles and unlock that value. And crucially, it's not just insiders. Look at the strategic partners.
Allseas and Korea Zinc again.
Yes. Allseas Group holds over 16% of TMC stock. Korea Zinc holds over 7%. These aren't just service providers, they are major equity stakeholders.
So the companies with the technical expertise to actually do the work, the collection, and the processing are heavily invested in the outcome.
Precisely. That provides a powerful layer of validation, suggesting they believe the technical and operational challenges are solvable. It reinforces that VC-like structure, a concentrated group of core believers betting on a potentially huge payoff.
Okay, that structure definitely screams high risk, high reward, time for the reality check. Let's systematically lay out the dangers. Chapter 6, Risk Assessment, the existential threats. If we quickly summarize the internal stuff using a SWOT lens, strength is clearly that exclusive access to the CCZ resource and the key partners. Weakness is the zero revenue, the cash burn, and yeah, that Nautilus history casting a shadow.
Right, but the really crucial risks, the ones that could kill the company, are mostly external, the existential threats.
Number one has to be the regulatory uncertainty still.
Without a doubt, the ISA mining code remains the single biggest threat. If the final rules are too strict, too costly, or simply delayed indefinitely, the whole project could become uneconomic. And equally important, if that US DSHMRA permit strategy gets successfully challenged in court, either internationally or domestically, that's potentially game over for their current plan.
Threat number two, the environmental fight isn't going away.
No way. The environmental opposition is strong, organized, and very vocal. You have NGOs, scientists, even entire nations calling for a moratorium or an outright ban on deep-sea mining. This creates huge reputational risk, potential consumer boycotts down the line. It's a major headwind.
And then there are the broader economic risks.
Yes, macroeconomic factors. TMC needs enormous future investment, billions, for full-scale development. So high inflation makes everything more expensive, pushing up those projected capex costs. And high interest rates are killer for their valuation model because they directly increase that critical discount rate in the DCF, pushing the theoretical value down.
But on the flip side, the big opportunity is still that geopolitical angle we keep coming back to.
It really is. The primary driver of the bull case right now seems to be U.S. political and strategic support, fueled by the U.S.-China rivalry over controlling critical mineral supply chains.
So if the U.S., for instance, slapped tariffs on processed battery metals coming from China or other non-allied countries,
that would be a massive boost for TMC. It could create a protected, premium-priced domestic market for their nodules, assuming they can get them processed, perhaps via Korea Zinc or eventually onshore. That geopolitical outcome is probably what the bulls are banking on most heavily.
All right, let's try to tie all these threads together. Chapter 7, Conclusion, the zero margin of error.
It really is a tale of two extremes, isn't it? The bull case, you've got this potentially generational resource critical for the green transition, maybe extracted more sustainably than land mining. You've got powerful geopolitical tailwinds and a technically de-risked model thanks to Allseas and Korea Zinc. It could be huge.
In the bear case.
Existential regulatory risk via the ISA or legal challenges to the U.S. route. A history of failure in this exact sector hovering over management. Technology that's still unproven at full commercial scale. Intense, potentially deal-breaking environmental opposition. And a business model that's incredibly sensitive to macro factors. It could easily go to zero.
And we have to come back one last time to that core valuation finding. The stock price today, around $8.89, is sitting right on top of the most optimistic DCF value, the $8.86 number.
Which tells you everything you need to know about the current market pricing. It's pricing in perfection, it assumes everything goes right, smooth U.S. regulatory approval happens quickly, scaling up the technology works without major hitches, commodity prices stay favorable, the environmental backlash is manageable, the ISA doesn't throw up insurmountable roadblocks.
Basically, zero margin for error.
Exactly. For a new investor coming in today, there appears to be very little, if any, margin of safety built into the price. You're not buying value, you're buying a high-risk lottery ticket on TMC, successfully navigating all these massive, largely unprecedented challenges driven primarily by that geopolitical narrative.
That really crystallizes the situation. And it leaves us with a final provocative thought for you to consider. Given how much the U.S. political support, driven by that rivalry with China, seems to be propping up this venture, will the ultimate fate of deep-sea mining be decided by careful environmental science and international law? Or will it simply be driven by raw global competition for mineral dominance? Something to chew on. Well, this has been our deep dive into TMC, the Metals Company, Inc.
We certainly hope this helped you get well informed quickly.
And remember, if you want research like this on a specific company, members can just drop the ticker in the comments on Stock Analytics AI, and we'll add it to our list. Just a final important note. This analysis was generated using an AI system. It's intended for educational and informational purposes only and should definitely not be taken as financial advice.
Please always do your own thorough research. Consider your own risk tolerance and maybe consult with a qualified financial advisor before making any investment decisions.